Swing Edge Pro, the intelligence feed for decisive traders.
All right, let's get started. This is a tactical intelligence briefing, and we have one target on our radar today, VITL Farms, ticker VITL.
So, what's the mission? Simple. We're going to break down all the incoming data, find those critical variables, and figure out if VITL Farms has the strategic edge we're looking for.
Okay, here it is. VITL Farms, it's a food company, yeah? But it's been lighting up our proprietary scanner for a few reasons. It is showing all the classic signs of a potential high-velocity setup. And you know what that means? The potential for a really fast, significant price move.
Right, so let's break down how this edge is actually built. We're moving into the detection phase now, looking at the specific data points that create this whole bullish picture.
Now, this is where it gets really interesting. Check out this raw score. VITL Farms meets 8 of our 9 primary swing criteria. A score like that, an 8 out of 9, that immediately pushes this stock to high priority status. We have to dig in.
First up, proximity. The stock's trading just over 5% off its 52-week floor. For us, that's huge. Buying near established support is absolutely foundational to how we manage risk.
And look at this. This beautifully illustrates the structure we're seeing. We have a confirmed triple bottom pattern forming. For any technician, this is a classic reversal signal. It suggests the sellers they're getting exhausted, and a really strong support base is being built.
Now, don't think for a second that this is some failing company that's just limping towards its lows. No way. This number, that's year-over-year revenue growth, almost 28.5%. That's smack in the middle of our target zone of 20 to 30% for a high-growth name.
So here's a crucial piece of the puzzle: ownership. Institutions hold over 103% of the float. Insiders, a solid 20.68%. Now I know what you're thinking. How can it be over 100%? Well, that happens when shares that are lent out by institutions get sold short and then bought by other institutions. It is a massive signal of extremely high conviction from the so-called smart money.
Okay, let's shift gears. We've looked at the company's internal health. Now let's zoom out and look at the external market forces acting on it. We're talking about market pressure, and specifically the potential for a short squeeze.
And this is the key pressure metric. Over 35% of the entire float is sold short right now. That is a huge pile of bearish bets that can turn into pure rocket fuel if any good news drops.
And here is the major disconnect. While all these short sellers are piling in, Wall Street analysts have a strong buy consensus with a price target way up near $49. That implies something like 80% upside from where it is now. This is just a massive, massive divergence of opinion.
You know who else is seeing this tension? The options market. Implied volatility is way up there at 58.6%, putting it in the 76th percentile for the year. What that means in plain English is that options traders are betting on and pricing in a huge price swing in the very near future. The market itself is expecting fireworks.
So we've detected the edge. Now for the fun part, the execution plan. This is where we take all that analysis and turn it into clearly defined tactical zones for a potential trade.
So here are the mission parameters. Our entry watch is that critical support zone right around the 52-week low, so 25.52. The main profit target is that analyst consensus up at 48.90. And the big risk factor we have to watch is the upcoming earnings report. The options market is pricing in a potential move of plus or minus 10.3% on that day.
Okay, let's wrap this up with our final briefing. We've defined the setup, we've got the tactical plan. Now let's just quickly summarize the fundamental catalyst that could light the fuse on this whole thing.
So 3 core things are providing the fuel here. First, management's confident. They just raised their guidance to $775 million for fiscal 25. Second, they're expanding operations, getting rid of production bottlenecks, which paves the way for that growth. And third, the brand itself is just strong, with growing awareness and proven pricing power even now. This is the bedrock that the whole technical structure is built on.
And this quote right here from the analysis, it just nails the entire thesis. You've got strong fundamentals that are completely disconnecting from a weak stock price. This is the classic signature of a potential bear trap, designed to shake out the weak hands right before a big move higher.
Which leaves us with the final big question.
Is this crazy disconnect between the fundamentals and the price action a trap for the bears, or is it the ultimate strategic edge we've been scanning for? That's what we need to determine. Session complete.
Swing Edge Pro, the intelligence feed for decisive traders.